We are live. You're watching the Merged Marketing Podcast. You're listening to the Merged Marketing Podcast. My name is Jason Hunt, and I'm here with Scott Duke today. Scott is the founder of openroad.io, that's OPNROAD.io, and Gateway Capital, organizations focused on helping business owners with revenues of 1 million to 10 million prepare their companies for sale into the private capital market. An MBA from the Jack and Certified Business Intermediary. Welcome to the show, Scott.
Jason, nice to be here. Happy to be on board.
Awesome. Today we're talking about preparing your business for a 5X to 10X acquisition. And Scott is the go-to guy to talk about this very topic. Scott, let's get started by talking a little bit on how you got into the business of selling businesses.
Yeah, it's funny because I know your background a little bit comes from the dental practice area. Like back in the day, I think you started in that kind of marketing that space. And I was in the dental chair. I had a bike accident recently, and so I was in the dental chair. And one of the people working on my teeth were, well, what do you do for a career? Like just asking a random question, just kind of a conversation. I said, I sell people's companies. She goes, oh. That's an interesting job. Just like that you would never think of that job even existing, right? So unless you're kind of in the space further along in your entrepreneurial career, it doesn't even get pinged on the radar as a career choice, right? So anyhow, I got into it how most people get into it. So this is the mic kind of like bouncing around up here, so I'll move it out of our shot. But I was an entrepreneur. That's basically how I started in this space. I ran a bunch of small companies, and those that are listening to your podcast, if they're entrepreneurs, then they've probably done the same route, right? You start almost with the hot dog cart stand, or start with the lemonade stand, painting company when you're a kid, and that kind of grows into different things. And we ran a bunch of companies, and as they got larger, you get to a point where maybe you're burnt out of it, or you want to do something different. You don't really know what to do with it at the end, and oftentimes what you end up doing is just shutting it down. And I had 3 companies that we just did that. We grew them to the point of profitability, kind of rocking and rolling. And I just get bored as an entrepreneur. So you just shut it down. And at the time, I didn't know that there's this whole M&A space. There's this whole world where people transact companies. And then as you kind of look into it, like, oh, maybe I shouldn't shut this down. I can extract value out of it and roll into the next one. That's how I got into this space. So basically myself running companies and then kind of figuring out how to sell them. And then once you do that for a while, you say, I can help other people do this. So that's how I got into it.
How do you prospect? How do you go out there and find companies that are actually thinking or considering, or maybe they don't even know they're in a position to sell their company? How do you prospect those businesses?
It's brutal. That's the hardest part of this company, is like the tip of the spear is so difficult, because the average person that's thinking about selling their company, they decide to do it. They wake up one day like, I'm frustrated, or they wake up one day and they have a health scare, or they wake up and they're like, I'm not spending enough time with my kids. My company is just draining me. That feeling may be there for a while, but the actual decision to sell, it happens on any given day, right? And it's so the question is, how do you prospect and how do you find someone at that moment in time when they actually have that feeling, so they end up communicating with you? The answer is probably what you guys talk about a lot in your marketing podcast, is that you just have to be omnipresent. So you need to be doing stuff like we're doing right now, getting the message out there. You need to be running events. You need to have your YouTube channel. You need to be in your local community and just networking. Oftentimes business owners, they communicate first with their accountant when they're thinking about selling. So you want that network of accountants, whether you're in a geographical area or you're kind of working nationally, you want that network and people to know about you. So we've built affiliate programs, and we have things like that build on our networks. But mostly it's that omnipresent, so that on that day, business owner always wants to increase sales. So they're always hunting for that, but they're not always hunting for selling. So you just have to make sure on the day that they decide, and do that Google search, so you're going to be there. Yeah.
We spend so much money on paid Facebook, paid Google, SEO. Well, we don't pay for it because we do it, but by spending all that is great. You get a lot of leads, but it's the quality of lead which can struggle at times. And but now we're starting to build out, much like yourself, these affiliate programs. which are proving to be awesome in terms of generating a solid lead or a solid referral. Do you invest much at all into the paid, or is it strictly just relying on the referrals?
We don't do a ton of paid. We've done a fair bit of Google testing, and what we found in our industry, because I'm in this industry about 8 years now, where that's solely I'm just doing business sales. Prior to that, I own a real estate company, and we mostly focused on vacation rental, and then we sold that to private equity. But for the last year, I've really trying to been figuring out, like, how do you skin this cat in the M&A space? And like you're talking about the affiliate programs. So we did some Google advertising, but in this space, people really need to have a high level of trust with who they're dealing with. And more so than I'm going to sell a pair of sneakers, or I'm going to, I don't know, maybe there's some urgency that someone needs to have some excavation work done at their house or whatever. Those are the kind of things that you can put up on SEO. Someone can find you, they can call you, your price works, and away they go, right? Selling your business is, it's close, and maybe it's akin to selling your home, but selling your business, you need to have so much more trust with the person you're working with. And there needs to be that multiple touch points before you feel like, okay, I'm going to put my biggest asset and what I've been working on for the longest period of my life in the hands, or at least I'm going to partner with this individual to do a sale, right? And do our transaction. So you need that, going back to that omnipresence, you need stuff like this. You need the podcast, you need it, because then people can listen to you and they go, okay, this person knows what they're talking about. I feel comfortable working with them. They can see that they've done transactions in the past before. You have that avenue, and then you have borrowing trust off of some of their other trusted advisors. And the affiliate program is more like the borrowing trust, right? It's all right, I trust my accountant deeply, I trust my lawyer deeply, I trust my wealth planner deeply. And it's like, if my wealth planner trusts Scott, then I can trust Scott, right? And that's where the affiliate program comes in. And we've done a lot of work on that over the last year. Is kind of building an app and building a network, because for those listening, the business marketplace segments into a couple categories, but you can segment it by revenue. And in our industry, and when you get into thinking about selling your company, you get segmented by revenue, and more than that, you get segmented by earnings. So buyers, they look at and they say, okay, your earnings are under $500,000 a year. That's your EBITDA. It's under $500,000 a year, or your earnings are over $500,000 a year. That's a huge segmenter. And then it goes up in $1 million chunks from there. It's like, you make $1 million a year, you make 2 million, you make 10 million. And each one of those gaps, or those, the value ladder jumps, they're serviced by different people in our industry. So business brokers, the traditional business broker, or realtor, they're servicing businesses that are doing kind of under that $500,000 a year. And then there's your M&A advisors that they're doing kind of $500,000 a year in earnings, and up, until you get to that kind of $10 million mark. And then you're working with investment bankers. So for us, we've kind of like carved out this little section where we're between that 500,000 and $1 million. And oftentimes those opportunities, those businesses are looked over by your traditional M&A. So our affiliate networks is traditional M&A that they don't want to work with these owners because they consider their business is too small. And we're like, hey, this is the perfect size. Like, this is awesome. And so they're basically our affiliates. And so that's how we've kind of worked that.
So do you have like a Rolodex of buyers that are waiting for you to present that new business to them? How does that side of the coin work?
Yeah, for sure. This side of the coin has developed in the last 5 years massively. And it's to a significant improvement to, average business owner, right? Before it was, okay, I'm in the M&A space, I'm an M&A advisor, and I've been spending the last 25 years of my career building up this traditional Rolodex, where it's like, okay, here's my Rolodex. And each person in there, this person buys mines, and this person buys commercial buildings, and this person buys dental practices. So you have that's how your Rolodex is broken out, and that takes a lifetime to build. You don't need that as much anymore, because now there's these networks out there, like Search Funder is a good one, Axial is a good one, and these are sites where the buyers live. And for business owners that are listening, the rarest commodity in our marketplace right now is your business. Like, that is the rarest commodity, and that is what everyone is searching for. The buyers, there's lots of buyers. there's so much capital sloshing around in the market right now that it's actually unbelievable when you kind of look deeper into it. And they're all looking for opportunities that have lower risk and decent return, right? And everybody's out there hunting for it. And that's the job of us as advisors, is to partially to go out and find owners that are thinking about selling, and then prepare their business so that all this capital out there and all these buyers will find their business attractive. But that's the one thing that maybe people can take away, is that you are the rare commodity in the equation. It is what everyone is hunting for. So as long as your business is set up properly, then you should be able to transact it. Yeah.
Let's dive into that, which is kind of the meat and potatoes of the episode, which is preparing that business. Yeah. What does a business need to do before being in a position to sell?
Yeah, for sure. So you really want to, and this is maybe difficult for some businesses, because the vast majority of the businesses in the world, and especially North America, do under $1 million a year in revenue. And that's just the reality. And when you segment out the marketplace, and I'm in Canada here in British Columbia, but if you segment out Canada and you can kind of look at the stats, whatever the information the government puts out, about 97% of businesses, definitely 95, but even up to 97, are under that $1 million a year, right? So for most people that are listening, and most people that we're talking to, just statistically, that's where you're going to be. And if you're there, your primary objective is to show $150,000 of revenue, or of earnings, sorry, in your business. That is it. That is your primary objective. And that is
so 15% margin for $1 million business.
Yeah, well, businesses don't necessarily run 15% margin. That is also, there's not many out there that do that. So there's a book behind me on the shelf called The Business Reference Guide. And oddly, this was like last week, just because I don't know, because I'm in the industry and you're in marketing, so you'll be looking at marketing stuff, and I'm in this space, and it just kind of intrigues me. It's a 350-page book, and each page has an industry on it and what their average margin is. And I just sat in the hot tub for an hour and a half and just went through the thing. And I took notes of how many businesses are out there, industries that are making over a 15% margin. I actually used 10, and there was only about 40. So in that whole book,
40%.
40 period.
40 period.
40 industries. Yeah.
Wow.
So and these are averages, right? So it's like you say your industry is, and one that really jumped out at me, which is interesting, is garage door installers.
Okay.
So garage door installers are on average making a 23% margin. I'm like, that's fantastic. And the other one that really jumped off the page, because it was just so high, was airplane cleaning. So it's like you come into the terminal and you get off your plane, and in between you getting off and the next group getting on, there's about a 15-minute window, right? And in that time, the whole plane needs to get turned over. So these companies, they have to be registered to be able to be in the like security clearance and that kind of thing. So, but they're making 40% margin, 40%. I'm like, yeah. Wow. Like that's phenomenal. Like it's kind of hitting like tech numbers, right? So anyhow, just kind of going back to where we talked about it, the 150 of earnings becomes important for the business owner that has the smaller business, because whoever is most likely to buy you is going to be an owner operator themselves. So they're going to come into the business, they're going to step into your shoes, and their opportunity is, endless of what else they can do with themselves in their career. And they may be leaving a job where they're making $75,000 a year, or they're making $100,000 a year in their position that they're currently working. So you need to, as a business owner, showcase the fact that, hey, listen, if you purchase this business, you get a bunch of benefits. You get the benefit of being your own boss, which is the number one thing that, when people acquire businesses that have never owned a business before, they're looking for that freedom, right? They want to be their own boss. They don't want a boss over them. They want their own control. So that's a big piece that you're hanging out there. But what they really, really also want is to, they don't want their lifestyle to diminish in any way. I've got a mortgage, I still, paying into my kids' education fund. I want to go on these certain holidays. There's, maybe I have loans on a boat or a vehicle or whatever. I still need to cover those costs. So I'm looking at the salary that I'm making today, and I'm saying, is this business going to provide me with an equivalent lifestyle from a cash perspective, and then also give me the benefits of being a business owner? So those are the kind of the big pieces that they're looking at. And then a smaller piece is is there enough cash flow here to do those two things and then also service the debt? Because a lot of the sellers don't often think, normally they've run their business for 10 years, 15 years before they're thinking about selling it, and they have no debt on the books. And for small businesses, normally they've already paid it off, right? So they aren't thinking about it from a debt perspective, whereas the buyer, the day they buy the business, is taking on debt. They need to service that, so that becomes part of their equation. So that's why I say that 150, if it hits the bottom line, and we use seller's discretionary earnings, so that also includes the income that the owner is paying themselves. So you basically have the earnings that you're earning, and then add on your salary, and that has to total to around that 150 is kind of the sweet spot. If you hit that and you're a small business owner, you will be able to transition for sure. Now, if we go up the tier and you go up above that and you're a little bit bigger than that, now you're attracting strategic buyers, right? So these are, maybe they're private equity funds, maybe they're institutional investors, maybe there's a family trust out there that's, rolling up companies in a certain sector. Maybe it's a search fund. This is people that are graduating from Harvard and they're just looking to buy themselves into a role. So there's lots of people at that stage. It's a little bit higher. So now your company is maybe making $2 million a year and it's driving that $500,000 to the bottom line. What's really important at the section of the market is that your company can run without you. It becomes critically important. And it's like the first thing that people look at. So if there's a takeaway for those business owners that are listening, that are in that swath, it's everything I call it every day a step away. And that seems to like resonate with people, that little saying, every day a step away, because it's easy to go into your work on a day-to-day basis when, you're the founder and the owner, and just think about that as you're running your day. It's like, okay, the phone rings, I answer it. I'm having a phone call. That's a sales call. What if I'm not here? Who takes that call, right? That's every day a step away. It's like, what if like you're hiring a new staff person and you're sitting in the interview and you're kind of going through the interview? It's like, if I'm not here, who's here doing this? That's like kind of every day a step away. And it's down to the minutia. It's like, what can I delegate? What can I automate in my business? What can I systematize so that it's not me actually doing it? That is what the larger investors care about the most. They care about your replaceability. And what we do when we work with a client is the first thing that we do is to kind of look at their org chart, and say, which oftentimes, to be honest with you, is 90% of the times people don't even have it. So it's like, okay, let's just sketch it out. Let's build your org chart here. And that exercise alone is kind of nice, just seeing where the people are in your organization. Then you build the org chart and it's like, okay, you're kind of at the top of the pyramid in your org chart. What happens when you go away, right? It's like, how quickly does this thing collapse? And then John Warlow, who's a big guy in our space, he's like, if we draw your org chart and it's a hub and a spoke, like you're the person in the middle and everything's kind of reliant on you, and you pull you out and it just collapses, that's an unsellable business, right? So you take that org chart, and the first thing I do with people is I say, okay, who's the best person in your company? Who's your key person you couldn't ever lose? And there's always somebody there. It's like, all right, then that person now is your general manager. And we are taking them on the org chart and we're putting them right to the top of the org chart. We're giving them a bump in their salary. We're giving them more responsibility. We're kind of celebrating that that's happening. And then now on that org chart, it's not completely relying on you. You have your general manager and everyone else is below them. And then now you can put you at the top. And when you get taken away, no one cares because the general manager is still handling all of your company. That piece right there is, that anyone who's listening is thinking about selling, that alone right there is going to make you some extra hundreds of thousands of dollars on your sale, because it allows you to now start marketing to a whole different category of buyer.
That's brilliant. And what percentage would you say does it happen where a company will have to take on that existing business owner, CEO, whatever, for a period of time? Is there typically a percentage where you'll see them stay on for a year or two, or part of a contract? How does that work?
Yeah, so you get even bigger, like a little bit even bigger than that. You're going to be into staying on probably. And this is the other thing just to kind of even go high level, and then I'll dive back down and answer your question. But what people are really looking for that have money is they've got money. They want to keep their time, right? And they want more money. So they have capital. What the scarce resource for them is humans. It's like skill. That skill set out there, right? And if you're a founder, you're an owner, you've proven to the marketplace, I have skill. I have the ability to create something. believe me, you are a minority, a huge minority in the marketplace. It's like the 0.001s probably that actually like crack through that barrier and last for 10 years, right? Capital wants you, and it wants you around, and it knows that if you stay in this business for a period of time, the probability of this business being successful and the cash flows that it's been generating in the past carrying into the future is higher. So what that does for a buyer is it reduces the risk for them of this asset they're purchasing, right? Because they're looking at your business as an asset. It's a financial asset to them, and they're always trying to reduce risk. So if the owner stays around a little bit longer and it transfers their knowledge, transfers their skill set, transfers their network, that will reduce the risk of this asset that's being purchased. So just to come back down to your question, this happens a significant amount. So the larger the business gets, it's like your 60%, 70% of these deals are expecting the owner to stay on for a period of time. As an owner, by the way, you're always staying on for a period of time, but it's, smaller businesses, it's 2 weeks. We just did a deal in June where they were staying on for 3 months, and that was kind of the longest that I've seen in a small business. But if you have a larger business and you're selling to, especially to private equity, they want the owner to stay on for sure. You could be looking at a year, 2 years, 3 years, and there's going to be earnouts tied to this. So if you perform, you make more money from the sale. There might be royalties tied to it, all sorts of stuff. Like every deal is structured differently, but you have to understand you are valuable in your company, and if you stay around, you reduce the risk, and that's why a buyer wants you to hang around for a little bit. So just factor that into your exit plan.
So let's say, Scott, I wanted to sell my business today, and I say, Scott, how long is it going to take to sell my business? What's the process?
Yeah, for sure. So I'm part of the IBBA, it's the International Business Brokers Association, and it's a great organization. They also have M&A Source, which is kind of the tier up from that. And they put out a quarterly report where every single, I would say active broker, like not everyone's going to fill out the report. I fill out the report because I like the stats that it gets afterwards. And it comes back and it says, okay, this is the period of time from taking a business to market and to actually being sold. And there's no, black and white because of the spectrum's kind of all over the map. But the kind of the head of that chart, it starts at actually I just looked at it yesterday. So the start was someone sold in a month. I'm like, whoa, way to go! Like you went to market, you sold in a month. The quickest we've ever sold a business was 2 months. And when you see that, it's not to get excited about. If a business sells that quickly, it means there's lots of urgency. Maybe the owner had a heart attack. Maybe who knows, right? And I can tell you that business is sold that quickly. It did not sell for the value that the owners wanted to sell it for, because urgency like that from the sell side, urgency like that will erode value. And then on the other side of the spectrum, kind of on the tail end of the chart, there was a business that took 3 years to sell. So this was kind of encapsulated this report. Now, where it lands most, like that middle, kind of the highest, like right in the middle of that bell curve, was 9 months. So that's what people can be expecting. It's like, all right, you take your business to market and you're likely going to sell, probabilistically you're 9 months. Really the triggering point when when things are actually going to happen is after you get a letter of intent. So after someone comes through and says, I've interest enough that I'm going to make you an offer and we're going to go into due diligence. Once you hit that mark, you're about 2 to 3 months, kind of on the longer side, 4 months to being out of your business. That's the real marker.
What are a couple of red flags that buyers or yourself would see in a business that wants to sell? A couple of big red flags that you'll be like, no, you're not quite ready yet.
Yeah, I mean, the biggest red flag is owner dependence. And like it's the hardest thing for us as owners because naturally we want to feel special in our business. We started it. We want to feel that it can't run without us. So people have a hard time learning. It actually takes a while to learn how to delegate. Like you would know, Jay, like it takes a while. It's like just to kind of know by the way, the person you're delegating to is only going to do the job in the beginning between 50 to 70% as good as you can do it. And that's why we have a hard time delegating. It's like, if I hand this over, to Jack, then it's only going to be done 70% as well. And, I just really want my clients to get that 100% service. Well, sure. But if you don't get if he doesn't get a couple 70% hits, you got to give the guy some time at bat, then you're never going to step out. Right. So you got to kind of take that leap, that delegation. But that's a big thing that people look for. They're like, how dependent is this machine on this owner, right? So that's number one. They're definitely looking into the financial situation, right? So one of the easiest things you can do to add value before you go to the market is the next year, 2 years, 3 years, if you're going to sell, just start actually driving all your profit to the bottom line. Like, don't care. This is big too. We, through our life as entrepreneurs, we really think about reducing tax. And it's like one of the things that we really love doing, because we start our business and like now we have this new gem that we get to work with, which is writing stuff off, right? So it's like, okay, I can like fill my truck with gas and, you know, it's okay, it's a write-off. And it actually it's really great at the end of the day. And you kind of load your business up with expenses, maybe unnecessarily, so that at the end of the day, your tax burden is reduced. This is common. And it's kind of we all do that, right? But what you have to remember is that the amount of tax that you're saving, like maybe if you're on the kind of upper echelon, you're paying 20% in your business, but you're probably paying, I mean, in Canada, maybe you're paying 16% on each dollar that drives to your bottom line. When you sell, and this is the title that we had kind of below, it's like sell for 5 to 10 times, right? That's based off your earnings. So you got to remember that. Yeah, there it is, right? So like that's based off your earnings. So when you know you're going to sell, for goodness sake, like, give your head a shake, right? It's like drive as much as you can to earnings, because that's going to be multiplied by the average is 3, right? And, you know, we talk in the sessions that we run and the events that we run about how to get it up to 5 and get it up to 10, but it's like, that's going to be multiplied. So it's so important to like drive as much as you possibly can to your income line at the bottom, and just forget about like your accountant's gonna be like, no, save taxes. I'm like, no, like maximize for your multiple, because that's really what you want at the end of the day. So kind of think about that. The other big things that people look at is like, are your key staff staying around, right? Like, this is another big one too. It's like, all right, you know, what's your customer concentration? And this is, you know, Rob Slee, who's like a huge in our industry, and he wrote the book Private Capital Markets, and it's like this thick. But he's like, is your business one phone call away from oblivion? And it's like, ask yourself that question. Am I one phone call away from oblivion? And if you have, this happens oftentimes with businesses that service government contracts, is you have, you know, one big government contract, and that's, you know, 80% of your revenue in your business. And they call you one day and they say, hey, we're not renewing this contract this year because, you know, policies have changed, whatever. You're toast, right? It's over. And this is something that buyers obviously look for, because, you know, they're worried about that risk element. And so that's another thing to look at. It's like, am I one phone call away from oblivion? Do I have too much customer concentration? Am I too reliant on a vendor? These are things that buyers look into.
This has been awesome. What's that?
Oh, you were paused a bit on my end, but you're back.
Yeah, no worries. I'm sure Tex will be able to fix that issue. We're good with that. But Scott, this has been great. Thank you so much for the value drop today. If people have any questions for you, what's the best way to get in touch?
Yeah, for sure. I mean, you can find me on LinkedIn if you just type in Scott Duke. This behind my head this whole time is our website. That's openroad.io, so people can go there. The other thing I was going to do on the podcast is for people that are just on the cusp of thinking about selling, we have a little course called the Business Sale Navigator. It's maybe 2 hours, something like that. I'll give you the link so your listeners can get it for free. But that's a really good place to start, because it shows you, okay, the questions you asked, dives in a bit deeper. It's like, if you're trying to generate value as you go to sell, this will show you the road. It also gives you a map of like what it looks like selling a company. So, but yeah, LinkedIn's the best place to contact me.
Awesome. Look for that link in the show notes of this episode. This is episode 97. So make sure you check that out. Scott, this has been great. Thank you so much.
Yeah, Jay, thanks for having me on the podcast. It was fantastic.
Awesome. And there you go, Scott Duke from openroad.io. That's OPNROAD.io. Definitely some food for thought in that episode there. You know, specifically speaking, the importance of delegating is a big takeaway for me in that episode. If the business is too reliant on you as the sole owner, or the relationships you have, or, you know, the networking that you're doing, if you're the face of the business, you know, it sounds like it makes it a little more challenging to sell that business when there's so much emphasis on you being the sole owner of that business. So it's good to delegate. I love that breakdown that Scott gave in terms of hiring that general manager to take on a lot of those tasks to alleviate you from being in the business. And I thought that was very important. If you guys have any questions, make sure you reach out to Scott at Open Road. He'll be happy to help you there. And check out the show notes for that link that Scott was talking about. Thank you so much for listening. Thank you so much for watching the Merge Marketing Podcast. Don't forget to go over, give us 5-star review, and give us a subscribe. We will appreciate it. Thank you so much. Don't settle for good. Be great. We'll see you soon.